Hey guys, I'm Spencer Smith and this is Pete Dorn. We're both of ParetoHealth, and today we're going to talk about specific versus aggregate stop loss. So why don't we talk, Pete, you mentioned spec and ag. I'm going to take a moment and go in through spec, and I want you to sort of layer on top of the things that I'm describing here. But let's look at this illustration real quick so that we know what we're looking at. We've got 100K, what I call ISL. That's individual stop loss, or that's specific stop loss. Spec, deductible, there's a lot of different terms that all mean the same thing. What this is doing, spec insurance specifically, is controlling the per person catastrophic risk. So the low frequency, high severity risk that you might incur on a plan. So what that looks like visually, you've got that $100,000 deductible that I've drawn in the red line. I've got a person that has gone over that deductible and has an overall $150,000 claim. So what happens here? What happens with these dollars, Pete, on the spec side of the equation?
That's correct. So the specific limit is $100,000. You have a $150,000 claim in this case. And so this just means that the stop loss will kick in and pay every dollar over that, in that claim, over $100,000, in this case, $50,000 over the individual specific level. Mm-hmm. And so the client, the employer, will get a $50,000 reimbursement check from the stop loss carrier on that claim.
Yeah, so that's key, right? Reimbursement. So we'll talk about advanced funding here in a little bit, but this is a reimbursement contract. So the employer has that risk, right? They're responsible for it. But the stop loss carrier has agreed to take on that risk above that deductible level. So they will reimburse that $50,000 in this example. Mm-hmm. So a couple things that I want to weigh in on spec, and I want to hear your thoughts as well. Majority of your premium is going to go to specific insurance, right? P, what, maybe 85, 90% or
that's
above?
Correct.
Right?
Yep,
So
that's correct.
Why is that, right? Let's explain why most of my dollars are going towards this coverage, this spec coverage.
Well, I think we need to step back just a minute and just look at the industry in general. The volatility of large claims in our market today is out of control, okay? Mm-hmm. And it's even more severe than it was a couple years ago. In fact, one of our carrier partners on the stop loss side of things saw a 45% increase on the size and severity of large claims last year.
Wow.
That's in one policy year, 45%.
Are those $1 million and above claims?
That's correct.
Yeah,
and so think about claims that used to be $250,000 a few years ago, maybe 5 years ago. Those claims are now $500,000 or $600,000. Okay. So again, there's a lot of exposure for employers over their specific deductible.
Yeah.
Okay?
And those are much less predictable claims as well, right?
That's correct.
Yeah.
That's correct. And so again, the real dollars in stop loss, the real exposure for employers are claims above that individual specific level, okay? And so again, average employer might see anywhere between 3 and 4 claims in a given policy year go over that individual specific level. That's why as an employer you buy that insurance.
Yeah, and that's also what you're asking a stop loss carrier to underwrite and predict, which is relatively unpredictable, not only in when is it gonna happen, a claim that maybe like a hemophiliac joins your plan, or when somebody needs a specialty medication, all of a sudden that person shows up on a plan mid-year. They're trying to hedge or predict how much premium is going to be required for that risk profile. And so it becomes really, really hard to do on an individual basis. It's a lot easier to do, obviously, across a block of business or a pool like in a captive. So anything more that we need to touch on spec before we move to the other side of the equation?
Well, you mentioned it, the risk is really unpredictable, right? So in a world where we have companies acquiring other companies, right? Or we're hiring new employees, we're trying to grow our business, right? We don't fundamentally understand the risk of that particular employee or that group that you just purchased. Mm-hmm. And so again, the specific coverage of stop loss is going to cover you for those large claims and those people that you hire. The unpredictability of health insurance in general.
Yeah, that's why the insurance exists in the first place.
That's correct.
Right? Yeah.
That's correct.
So there's a specific stop loss, which we touched on. That again, that is the low frequency, meaning it doesn't happen very often, but also the high severity. When it does, they're usually very large claims, and that's what we're trying to predict. The other part of that equation is aggregate insurance. So what is aggregate on its own, and then maybe how does aggregate work with specific when you pair them together?
Yeah, so employers, when they self-fund, the bulk of their spend is going to be on those small claims. Technically, an aggregate claim is any claim under that $100,000 individual specific level in this example here, right? These are the doctor claims. These are the provider claims, right? These are the small drug claims if you're covering drugs under stop loss, okay? Generally, about 60 to 65% of an employer's total spend is on these small claims, okay? Obviously, there's liability there. And so we want to limit that liability for employers. And for that, we set aggregate insurance, okay? We set what's called an attachment point, a maximum not to exceed bucket, so to speak, on the small claims.
Yeah, I'm gonna take a second to flip through. I wanna make sure we pull that visual up because I think it'll help us understand that when we look at the attachment point.
Okay.
So attachment point, you mentioned that, Pete. That's our maximum liability claims for all of the claims that are underneath the deductible. That's a key distinction right there. Every claim for every individual below the spec. Any dollar above the spec goes towards the spec portion of the policy.
That's
But
correct.
all those dollars pull together towards what you said called an attachment point. So
That's right.
how do we derive an attachment point? How does a stop loss carrier come up with that number?
Right. Well, when a group is self-funded, right, the claims are in a sense predictable. Okay. We look at the claims from the prior year. Or I say we. The stop loss carrier will look at those claims from the prior year and underwrite them. Okay. They are going to put an element of trend on top of those claims. So we have, net claims. We're going to add trend to that, right? And then we're going to put what's called a stop loss corridor, an aggregate corridor on top of that.
Okay. Yeah, that's what I tried to illustrate here with this little zone in between the blue line and the red line, right? That's our corridor. So what does that mean?
So generally, that's a limitation of 25% more than those those net claims plus trend. Okay. So we're adding a buffer, so to speak, of 25% for that attachment point. That's how the attachment point is derived.
And so that number, that attachment point, gives us our maximum liability on the aggregate side of the equation for all of those claims like we talked about pooling together.
That's correct.
So I drew an actual line here, and I want to kind of explain how these things intersect. The blue line is that expected number, right? That the number that the carrier derived of what we believe claims will probably roughly be for the
It's
year.
generally about 80% of the attachment
Of the
point.
attachment
Yeah,
point,
yes,
right? So
correct.
we add a 25% buffer on, which is that zone where if we were to exceed that maximum number at the end of the year, in most cases, we're not talking ag accommodation right now, at the end of the year, if my plan spend under the aggregate portion is above that red line or that attachment point, I'm eligible for reimbursement by the stop loss carrier.
That's correct.
What happens though if I'm somewhere in between or below? What does that mean for me as an employer? Am I getting anything from the carrier for that?
At the end of every month, okay, you will receive a bill from the TPA, right? And the employer will have to fund those claims, right? So how much did their employees go to the doctor that month? How much did they use their health system? Okay, an employer will fund those claims at the end of every month. Now that number could be a small number, right? Or it could be a big number. It really does depend on the utilization of the plan.
Okay.
Okay. Right.
And so if at the end of the year, unless we buy something called ag accommodation, which will be covered later on in this video, at the end of the year, unless we bought that, since we did in this example, I have this purple line, the actual claims, coming in below that attachment point. So effectively, that employer is responsible for those fluctuations, sometimes called an EKG effect. They're getting used to the fact, Pete, that claims are going up and down, right? And they might exceed my monthly attachment point at some point. I'll have to fund those claims, but unless that at the end of the year ends up beyond that red line in this example, then I'm just responsible as an employer for that number. So talk to me about the that buffer that's put on there. Why do we do it? How often is it coming up into play? These are really predictable, but usually don't come into the fold that much. So why is there a lot of conservative projections built into the attachment point?
Yeah, I mean, so the attachment point, is developed by the stop loss carrier on a conservative basis. Okay. By the way, aggregate protection would cover, in generally most cases, claims over that aggregate attachment point by $1 million.
Okay.
Right. So there's $1 million of protection generally for employers, unless they want to buy more protection. Okay. But the bulk of employers out there are going to be at expected, or about 80% of that attachment point. Okay. Claims are very predictable. Okay. But also, stop loss carriers, reinsurers do not want to underwrite an ag claim. So they're going to be very conservative when they throw out that number.
How often do those come into play?
It happens from time to time, right? But generally, less than 3% of all self-funded groups actually have an aggregate hit or an aggregate claim, right?
That's a point I like to stress, right? You're going to see a maximum liability on a page, right? Whether it's an indication of ours or whether it's a spreadsheet, you're going to see this maximum liability number, and sometimes it might look pretty extreme. But that's because of that corridor. That's because you're looking perhaps a mature contract. And so I try to get people not to emphasize or stress that number too much. Yes, it's your worst case scenario, but it is truly a worst case scenario, and so you're less likely to hit that than you are somewhere below that number.
That's correct. Right. So when you're used to a fully insured renewal, right? In order to compare that to an attachment point in a self-funded plan, you have to ask yourself, what does my fully insured renewal look like 1 year in arrears of a year where I've had high claimants, right?
Okay.
Multiple high claimants on plan, where I've had high utilization of my plan. So a lot of my employees going to the doctor, right, in the same year. Okay, that 30 to 35% renewal that we talked about earlier and fully insured, that's the number that you want to compare that self-funded attachment, attachment point to.
Okay.
The maximum claims liability. okay?
Okay.
I think consultants and brokers across the country often compare the attachment point for groups coming from fully insured to their actual renewal, and that needs to be delayed by 12 months, right?
Yeah.
You need to see what that experience is in a worst case scenario on the fully insured side in order to compare.
Yeah, a lot of times it's a conceptual sale, right? And we're trying to get into the concept so to make sure the concept makes sense so you can see where the opportunity comes in. So I think we've covered